Hey guys, today I'm going to be talking about the Q1 earnings report for Iovance Biotherapeutics, which is currently sat at $1.66. So let's not avoid the elephant in the room here. This ER was a complete catastrophe. So I'm going to change up the structure of the video today because, as all the investors know, the big thing about this ER was the guidance. So the first section of this video, I'm just going to be talking about that guidance. That's going to pull me into the discounted cash flow earlier. And then for the rest of the video, I'll talk about the other points that came up in the earnings call. Now, I actually think the rest of these points were good points, but they just got overshadowed by this revenue guidance. So let's start off by going to the stock charts. And I did my first video on IOVA around this time when it was around $6. So it had fallen from around a $17 high, and someone had recommended the stock to me at that price. So when I saw this stock at $6, I thought it was certainly worth a second look. I didn't put any money into the stock because there's quite a few risks involved with this company. And I think in order to invest in this company, you really have to understand those risks. Since doing this video, however, the stock price has dropped down to $1.66, which is a drop I wouldn't have predicted in this time. So we can see here that this is the earnings call. So if I cut it back to 1 month, there's a significant drop off here. And the main reason for this is going to be the revenue guidance. That was dropped down from 400 to 450 to 250 to 300. That's a drop of 1/3 of the guidance alone and 50% of the revenue growth. If we go to the financials, we can see that they got $164 million in last year. So they were predicting up to $450 million this year. That would be nearly a $300 million growth. And now they've reduced that back to top end $150 million growth. So no wonder the stock has seen the significant drop that it has seen. The other thing of significant importance, if we break this down into the quarter, is that we can see that the revenue has had quite a significant drop. So this is not something you'd expect from a growing company that has just had an FDA product approved. And then on top of that, to make things even worse, is that they had a negative gross profit. So it actually cost them more to deliver their therapies than it did the revenue they got from them. So basically, the financials for this quarter look incredibly bad. But I don't think that this company is a write-off at all. I still think it's a very risky prospect, but they still have an opportunity to execute well and really increase their market cap. So let's dive deeper into what went wrong this quarter. So really, there's two main things. Why did the revenues drop so significantly, and why did they lower guidance? So they did address this in the earnings call. So if I go back to Ticker Taco and click on earnings calls, we've got the earnings call transcript here. So I'm going to answer the second question first because it's the most straightforward. So an analyst asked, why did they give guidance at all in 2024? And then again, why did they make such a massive downward revision? And Fred Vogt said that last year they basically calculated the guidance off of their possible manufacturing capacity. And then after working with the ATCs for a year, they've realized they're not going to be able to scale up that quickly. They were saying that some of the ATCs were onboarded quickly and took on patients very quickly, and other ATCs are taking much more longer to come up to speed, to take on those clients and to get those clients moving through successfully. So although this doesn't seem like the best excuse, if they are to be believed, then the demand is still there. It's just a way of meeting that demand. Of course, we always need to take this information with a pinch of salt, but they have still maintained that this should make over $1 billion in the US and over $2 billion ex-US. Now, this is going to be really important, as we'll see in the discounted cash flow later. So the next part to look at is why the revenue was so low in this quarter. So if we type in three key contributors, we can see here. So the first one that they talk about is the manufacturing facility. So this had some annual maintenance, which meant they could only produce about half of the Amtagvi for that month. The next were lower Proleukin sales, and they have attributed that to wholesalers who were selling stock. And they expect them to replenish that stock in the next quarter. And third, they again spoke about the ATCs and how each centre has been different on how many patients it takes on. So again, if management is to be believed, then these problems should dissipate in the next quarter. So the next quarter is going to be really crucial for the stock price. For me, at this stage, I haven't lost faith in management. I think it's quite possible that they've just had this bad quarter and that next quarter we will see that recovery. They even hinted throughout the earnings call that they might even beat guidance for the year. It's probably something that I wouldn't bet on, but it does make it seem like management are confident for the year ahead. So next I wanted to take a look at the discounted cash flow. So this is the discounted cash flow as I showed it before. And this is starting off this year with a negative 300 million for the year. I think at this stage it's probably more realistic that that's going to be around the 350 mark. So we can see already that that drops $300 million off their market cap. Next we need to look at the annual growth. So previously I had put that in at the 300. So let's assume now that they're going to make $150 million revenue growth in a year, and that's going to equate to $100 million in profits, gross profit. And then I need to copy that formula across. So this is probably one of the reasons that we see the low valuation that we have today. If this were to continue, then the company is only worth $100 million. However, they are still giving guidance for $1 million US and $2 million ex-US. So I assume once they have the ex-US up and running, then the yearly income will significantly improve. So let's say that starts to ramp up in 2027. So let's say they start to make $300 million revenue and 200 of that being gross profit. And then we want to copy that across into the other years. And now we can see a valuation for the company at around $2 billion. So that's already not bad for a company currently valued at only $550 million. However, this does depend on the perfect execution of Amtagvi for metastatic melanoma. However, as I've said for this company before, I think the real opportunity is in its other indications, like non-small cell lung cancer. If they can make a dent into this market, then it's going to be significantly bigger than metastatic melanoma. But as I said in the original video, a caveat to that is the risk that they play in these markets. They are heavily competitive markets with multiple companies, some of them the major players, also competing to get their share. So at these prices, there is a multi-bag opportunity here, but it's certainly not without its risks. Personally, I think the price of this company has gone too low now. But let's wait to see what happens in the future quarters. So now I'm just going to go through Ticker Taco because I want to update some of the points there. I said one of the ball points here was that they were a potentially conservative management. And that's because they gave a low guidance for Q3 of 2024, but I think that we can delete this now as a ball point quite safely after the guidance that they gave for this year. And then also strong guidance, this is quite ironic, of course. Oh, it's actually 450 to 475 million they guided for 2025. So that's an even bigger drop down than I thought previously. But of course, this is going to have to be deleted as well. That is no longer a ball point. They do still have the high cash burn, and they do unfortunately have slowing growth compared to their first few quarters. But all of these subpoints still seem relevant. Perhaps the gross profit margin increasing is at risk here, but I'm happy to leave it there for the meantime. So now let's take a look at what else happened in this earnings call apart from the revenue guidance, because I think that overshadowed nearly everything else. So quickly, one thing I did forget to mention was that they had an increase in patient drop-off and manufacturing success rates this quarter. It does say that this was an increase quarter on quarter, but it doesn't say exactly how much by. But this basically means that unfortunately patients were dying before they could receive the treatment, and also success of creating the therapy wasn't as high as they were hoping it would be. They have spoken about this though, and how they have been talking with the ATCs to make sure that they improve patient selection and also how they take the tumour from the patients. And they're saying that this increased expense should just be a learning curve. So another important thing in this earnings call, so they still have the United Kingdom, Canada and European Union approvals coming up this year. So I anticipate that these will be a boost for the stock price. And on top of that, they have also spoken about their regulatory submissions to Australia and Switzerland. So on top of that, the big one that I'm looking forward to is the lung cancer. And we can see here that they're also anticipating updated data from the registrational trial for non-small cell lung cancer, and also the first clinical data for endometrial cancer this year. So hopefully this year will be a positive year of catalyst for this company. They also mentioned the Iovance 301 trial. So they're saying that this phase 3 trial is also on track for frontline melanoma. They have the END 201 trial. This is for advanced endometrial cancer, which is expected in the second half of this year. And then they also have the IOVA 3001 trial and the IOV 5001 trial. And this should allow for Proleukin to be used with a wider range of solid cancers. So actually, I feel there was a lot of positive news in this earnings report, which was overlooked due to the revised guidance. Although there wasn't anything particularly new about these trials, it reiterated that these trials are on track, and the reason for why the cash burn is so high at this moment. So where do I stand now on Iovance? For me, I actually think that Iovance is a more convincing opportunity at this point than it was when I first covered the stock. And that's because the stock price is around 30% of when I covered it at that time. However, the peak sales guidance is still the same, and they are still on track with all of their other pipelines. They still also, however, have the same problems and risks, and that is the high cash burn with runway running out mid-2026. They're also in a highly competitive space with small and large competitors with products at varying stages of completion. However, if they are successful in reaching their peak sales, then they will already be a multi-bagger. If on top of that they are also able to reach any of their other indications, then Iovance is going to be a better opportunity still. So if you do like high-risk companies, I'd definitely dig further into this stock. If I hadn't just been burnt by Ardalex, then I'd probably be putting some money into this myself. For those currently invested, I feel your pain and I hope this stock turns around for you in the future. Thanks for listening to my video. Please subscribe if you'd like to hear more.